We have the latest IPO management joining us on the show. We have Mr. Sachin Gupta, who's a whole-time director and chief executive officer at IKS Health, joining us on the show. Along with him, we also have Nithya Balasubramanian, who's the chief financial officer at IKS Health. A very good afternoon to both of you. Thank you so much for joining us. And yes, you have the IPO that's open. We wanted to understand, you are a very niche player in the segment. If you could talk about the offerings of the company and what should one actually watch out for while subscribing to your IPO?
Thank you for having us on the show. Look, I think IKS Health is built on the thesis of the opportunity set that exists in US healthcare. As you might know, US healthcare is a $4.8 trillion industry, larger than India's entire GDP, growing at 7% in a secular manner. And when we started the business, US healthcare had some existential issues around the cost of care, quality of care, and access to care delivery. And in order to help with that issues, we decided to focus on one of the segments of the US healthcare market called the provider segment. And within the provider segment, instead of the hospital segment, we decided to focus on the physician groups, the physician clinic business, which is a $1.5 trillion market, growing at about 7%. And our simple thesis was that as we try to solve for cost, quality, and access in a world where the primary drivers of cost are chronic lifestyle disease due to the aging populations and sedentary lifestyles. The reality is healthcare will have to transform into a model where physicians start taking care of proactively of their patients and helping trying to preempt episodes of care in a way that it doesn't lead to hospitalizations and more expensive points of care. And so within that market, the way we decided to solve the problem was by helping these physician groups delegate what we call chore tasks, the tasks that they should not be focused on, that take them away from patient care so that they could focus on patient care. And the reality is these guys are spending as much as $225 billion on these chore tasks. So just to put it in perspective, the entire Indian IT services outsourcing industry is about $250 billion. We had found a TAM that's about $225 billion, growing at 7%. And we basically built a platform at the combination of proprietary technology that is then supervised by our global human capital, predominantly based in India, so that we can take away all these chore tasks from these physician practices so that they can focus on their core. And we do that because we do that using a combination predominantly of technology and people. We've been able to build this model in a way where we have industry-leading unit economics. Traditionally, our EBITDA margins have been 38, 39% at an organic growth rate of nearly 27% on a standalone basis prior to the acquisition that we did last year, which has further expanded our growth prospects pretty dramatically. The other thing that's interesting is, of this $225 billion that's being spent on these tasks today, only 30 billion has been outsourced so far. And that 30 billion is growing much more faster than the industry itself at about 12%. So at the confluence of the way we've built our platform, its scalability, our growth prospects within our existing customer base of 155,000 physicians, we feel like we built an outsized growth opportunity for the future.
Sir, you serve nearly 778 clients in total. What is the run rate of client addition that you have seen in the company, and what can we expect going forward?
So the way to think about this business is, the physician market in the US is consolidating very rapidly. And so we deliberately built a business that was focused on the consolidators, which are the physician groups that are buying all the other groups versus the ones getting consolidated. Because then the consolidators keep buying everybody else. Their natural inorganic growth becomes our natural organic growth. So actually the holy grail to our outsized growth is not acquiring a whole number of new logos, but it's really growing and cross-selling all the 16 features of our platform across the logos that we have already acquired. So about 85 to 90% of our growth every year typically is reflected in the cross-sell of and growth of our existing customers, and only about 10 to 15% comes from new logo addition.
So, Mr. Gupta, I wanted to understand what kind of growth opportunities are available in the US healthcare industry, and most importantly, where does your company, that is IKS Health, stand?
So actually, when you think of this US healthcare provider segment and the physician market that we're focused on, like I was saying earlier, it was a $1.5 trillion market segment that is growing at about 7% in a secular, irreversible manner. And within that segment, the tasks that we are able to delegate through our platform for these large physician groups, they spend about $225 billion a year on these tasks. Of those $225 billion, only 30 billion has been outsourced so far. But I think the financial pressures as well as the operating pressures on these physician groups have gotten to such an unsustainable point now where it feels like that outsourced TAM, the floodgates for that are really opening up, which is why that outsourced TAM of 30 billion is now actually growing at 12%. If you see IKS's historical growth rates prior to the acquisition on a standalone basis from FY22 to 24, we were growing at about 27% standalone. And so when you look at our historical growth rates, the massive customer base that we acquired through Acuity Solution into which we can cross-sell, and the fact that the outsourced TAM is already growing at 12%, we feel very confident that over the next 10, 15, 20 years, we should be able to offer outsized growth relative to that 12% growth of the outsourced TAM.
The company is a technology-driven company, so I wanted to understand what kind of technology upgradation or innovation is the company actually looking at going ahead, and also is the rapid advancement of AI and machine learning technologies a risk to the company?
We deliberately built the business in a way where our first attempt was to eliminate the tasks altogether by building proprietary technology. But because we are pragmatists, we also realize that technology often doesn't totally eliminate the task, which is why we've combined it with the human capital and the strength of the human capital, the 10,000 people strong human capital that we have in India. And so at the confluence of that, technology actually is the cornerstone of how we deliver these tasks. In fact, today, there are already about 7 or 8 use cases of GenAI built into these 16 features or 16 tasks that we delegate for these physician groups. And that's one of the reasons why we priced our model in a way where we have two pricing models. One model is one in which the customer pays us a percentage of their revenue. Another model is in which depending on the number of physicians in the customer's organization that are using our platform, they pay us a per physician user per month SaaS type of subscription fee. Now, in both of these models, our customers get so much value that they don't necessarily care about how much technology are we deploying, how many humans are we deploying, which means that the more and more technology we deploy and disrupt the human task, the better our margins become, because our customers don't care if we reduce the number of humans. This is a very distinct aspect of our business relative to the traditional IT services, BPO, outsourcing industries, where those industries typically get paid based on the number of people they deploy. And that's one of the reasons where things like GenAI are actually a huge tailwind in our business. The other thing is, given how fast this business is growing, scalability becomes a very important issue. And that's where we've seen some of the use cases of GenAI, where we built some models using GPT 3.5 that have fundamentally transformed the scalability of the features. One of the features that we have called clinical documentation used to require us to use one doctor in India to help one doctor in the US. But with our latest technology that we've deployed, which is GenAI enabled, now we have one doctor in India helping about 10 doctors in the US. So net, I think GenAI is a huge opportunity for our business, which is why we actually expect to continue to increase our R&D spends, which were traditionally about 5.5% of revenue, to closer to 7.5% of revenue over the next couple of years.
Right, you also have a lot of big tech companies that are entering into the healthcare space now. So how is the overall competitive intensity in the business? How is the company differentiating itself from the others at this point in time?
So, when you have a, $225 billion TAM growing at 7%, obviously you should expect competitive intensity. And it's good for the industry as well. But, because the TAM is $225 billion of these 16 features, sometimes the TAMs of each of the individual features can be quite large. For example, I was referring to our clinical documentation feature. The TAM of that feature itself could be north of $30 billion. So in scenarios like that, a lot of companies get built, which I call point solution companies, that are focused on just one or two or three of the features, because you can build $1 billion company just focused on that. That is what is representative of the market and the competitive landscape today, where a bulk of that 30 billion that has been outsourced is mostly going to these 1, 2, 4, 5 point solution feature companies. And that's the state of the market. Now, what we've realized, though, is that providers, as they are maturing and consolidating, they're realizing that they can't be in the business of buying 10, 12, 14 point solutions, integrating those point solutions, managing 10, 12, 14 vendors. they are starting to migrate more and more towards platform buying behavior, where the single platform solves for all of these 16 tasks. And our biggest competitive moat is that today we're the only company in the world that actually does justice to the full breadth of these 16 tasks.
Nithya, let me come to you. I wanted to understand the company has shown really good growth in absolute numbers, but the margins are actually declining. If you look at it from around about 39% that it was in FY22 to about 28% or so now. So if you could help us understand what's impacting the margins, is this because of the recent acquisition? And also if you could shed some light on how will you grow it going ahead?
Sure. I think if you look at IKS standalone margins, we continue to trend along the same 38, 39% that you've seen in our financials. When we acquired Equity was a lower margin profile business. So when we acquired them, their margins were about 12%, which is why the combined pro forma EBITDA of the two companies, the 12 months of IKS and Equity put together, in FY24, our margins have come off to 24%. However, a few things that you will already see. One is that we have been investing in trying to transform their business model to become more closer to ours. So we have been deploying IKS's technology as well as offshoring the human resources that Equity had. So through a combination of these two, we've already been able to expand that 24% margins to 28% by the first half of FY25. These numbers were published in the RHP. And as this transition and transformation continues, we hope to be able to expand the margins even further from the 28% that you see today.
Right. Nithya, let's talk about the debt on the books. If you compare it to about FY22 and FY23, there was zero debt, but your company is not doing any fresh issue. How will you reduce your debt going ahead? Are your cash flows sustainable or they're enough to take care of this?
So I think the fact that we're not raising any primary capital is already an indication that our cash generation will continue to be strong. If you look at it historically, our conversion from EBITDA to operating cash flow has always trended almost north of 95%. So which is why the $120 odd million debt that we had assumed during the acquisition has already now been pared down to almost $66 million by the first half. And again, if it's business as usual, you should see that number come off to an insignificant number by FY26 itself.
Right, Mr. Gupta, let me come back to you then. The company has more than 95% revenues coming in from the United States. It's good, but there is concentration risk as well. So how is the company looking to diversify into different geographies now?
Yeah, look, I think for us, that concentration is deliberate. We have, with a lot of care, built this platform in a manner that is truly specific to the US healthcare regulations. And like I was saying earlier, $225 billion TAM, of which only $30 billion has been outsourced, and that is growing at 12%. We are only a $315 million odd company right now. So we feel like there's a massive growth runway that lies ahead of us as it relates to growing the company in the US market. Having said that, we've been dabbling a little bit in the Australian and Canadian markets, which we'll continue to do. But our single-minded focus, we're like a horse with blinders. Our single-minded focus is until and unless we have a very large market share of the outsourced TAM and our growth slips to below double digits, we have no reason to look around. And with the US being one of the most prominent economies in the world, I think that is a risk that we can live with.
Also, Mr. Gupta, you have presence in the United States, but when do you actually expect such businesses to come to India? And also, if you could help us understand the role that your company would play in all of this.
Yeah, so I think the Indian healthcare market will eventually mature to this point, right? If you think about it, today, health insurance in India, for the most part, doesn't even reimburse clinic-based care. So as some of that changes, as the physician market starts to get corporatized in India, scales effectively, which is starting to happen if you look at some of what the PE firms are doing, they're consolidating some of the single specialties. As health insurance matures, as our per capita GDP goes up, and as our lifestyles become more and more sedentary and there's more and more chronic lifestyle disease prevalence, at some point in the next 5, 7, 10 years, I'm sure a model like this will be applicable in India. And our whole objective will be by that time we would have matured in the US, learned everything that there is to learn in that market. And hopefully we can bring some of those learnings into the Indian market and serve the Indian market at the right time. But I do feel like we're probably 5 to 7 years away from that.
Well, then thank you so much, Mr. Gupta, as well as Nithya, for joining us on the show and also talking about IKS Health, the business plan, the roadmap going ahead, and all the very best for your IPO and thereby your going ahead, your listing.